one of the chapters as far as financial accounting is concerned. One of the important chapters. I mean, important in the sense that examinable chapters. One of them is chapter 3. So if you have your material with you, good evening everyone again. Once again. Sorry. Good evening everyone once again. My name is Akande Apis, and you're welcome to Financial Accounting class. Tonight we will be dealing with we'll be doing justice to chapter 3 of the material. And I have with me here beautiful faces and handsome faces. Nice meeting you guys once again. So tonight I said I'll be introducing our new tutor that will be interchanging this class. Mrs. Purity, Miss Purity, please you can raise your hand if you're on this call, so I can acknowledge you. Yeah. Without wasting much of our time, for those that are just joining or for those that just join us, I will share the material to the platform for our use, and also I will share the material to the platform for our use. Also, I will make sure that whatever material I've sent in the past, I will forward it back so that we will all have access to the material as far as financial accounting is concerned, so I will not be lagging behind. Thank you all. So tonight, as I said earlier, we will be going to chapter 3 of the material. I'm trying to open the material from my end while I also share it to the platform. So the material has been shared. I think we have FA1 and 2 now. Okay. Okay. So the material has been shared. Now I'm going to share my screen also. So please confirm once you can see my screen so that we can start the lecture for tonight. Can you all see my screen now?
Yes.
Yes, sir.
All right, thank you.
Yes,
so
I can see
the all right, thank you everyone. Thank you. Now you can see now we move to chapter 3 of the material. Chapter 1. Okay, we have the YouTube link now. Chapter 1 is the introduction to financial accounting. Chapter 2 is the ISB standard, ISB framework. I mean, ISB what I mean by ISB is International Accounting Standard Board, the framework, whereby we are explaining to ourselves the guidelines, the principles, the policies that guide the preparation of financial statement. So now we are moving to chapter 3 of the material. Please, I want us to pay attention. This is what we do here. You come in with your notes, with your written material, your pen and your pencil and your book. So you jot down. If you have any question, I will always give us time to interact, or after the class, you send your question because I will give us time after the class to ask question. I'm saying all this because of those people that are just joining us. So we welcome you once again. Welcome to APEX virtual tutorial, financial accounting, as far as financial accounting is concerned. So chapter 3, we're talking of, not to waste much of our time, chapter 3 of the material is talking about the accounting equation. When we're talking of accounting equation, I believe that most people would have heard accounting equation. People believe, most people be like, accounting equation is, how do we actually call it? Okay, most people say assets minus liability, assets is equal to liability, assets minus liability is equal to equity, asset minus something is equal to something. Most of us have seen that in the past, either from one material or the other. But what does accounting equation actually mean in this sense? What do you understand by accounting equation? When you say equation, there's this word we actually use. We say equation must balance. It's the same thing with accounting. That means your assets must be equal to your liability. The equation must what? Must balance. So moving into accounting equation, there's so many things under this. The first thing I have here is talking about the simple representation of the statement of financial position. As I said in the last class, financial position means a statement that shows the position of the entity, which disclose the position of the company assets and the position of the company's liability as at the year end or as at that period. That was when I was explaining something about for the year ended and as at the year ended. One thing about financial position is the same thing that is being called, what's it called? Balance sheet. That was then. Now it's being called financial position. So what does that mean? That financial position is showing us the totality of the asset that the company has actually purchased since the inception of the company till date. That is, whatever information you need from the inception, from the day that the company actually started operation till date, you'll find it under financial position. As the asset increases, as it decreases, you see everything under the financial position because it's an accumulation of all the assets, all the liability, all the profits, and all the expenses that is being transferred to financial position. So that is to show the position of the company as at that present moment. Not to waste much of our time on that again, I was explaining, I said, a simple representation of financial position. That is where we actually dive into explanation of financial position again. So if you have my screen with you, this is saying assets. Asset is equal to what? Equity plus liability. What do we mean by asset? What do we mean by equity? What do we mean by liability? In the last class, I gave us an assignment to define assets, liability, equity, income, and expenses. The main reason for that is not for me to mark. It's for us to understand assets. It's for us to understand what they mean by equity. It's for us to understand what they mean by what? Equity. So the main reason for that assignment is that. So you permit me to call on two persons to give me the definition of asset. I have all of you guys, majority of people actually attempt the work, and I appreciate that. So my point now is that it's not only about attempting it, it's about you understanding what you've actually submitted, what you actually sent to me. So I'm going to call two persons to explain what we mean by assets. Now we're saying asset is equal to equity plus liability, which means that whatever equity that the company owns, whatever liability that the company has, plus their equity gives us what? It gives us assets. For example, if we claim that the asset of the company is what? Is 5 naira, which means we claim that the asset of the company is 5 naira and the equity is 2 naira. This translates to their liability being 3 naira because at the end of the day, if you add their 2 plus 3, it must give you the 5, the totality of their assets. That is what the accounting equation is saying. So now you permit me to call just one person. I said two. To give you the definition of our asset, liability, asset and liability only. I'm going to ask asset and liability. So I have Aisha Kinde. If you are here with us on this call and you're not distracted or you're not busy with something else, can you please give us definition of assets? What do you understand by the word assets? Based on the last assignment or based on the last class? Just a minute, just in 30 seconds. That should not take you much time. I'm not sure she's with us. All right, noted. Aisha Kinde, you're not with us. Okay. Atkins Toyin. Atkins Toyin, are you with us? Mr. George, mute your mic. I might be forced to remove you, sir. Thank you. Thank you, sir. Atkins Toyin. You see, that's what we say now. People will be complaining they're not able to join this class.
Can I go ahead and define an asset?
No, sir, Mr. Udo. No, Mr. Udo. If
Okay.
none of them is not giving us, if we don't have any of them giving us this definition, then I'll proceed. I'll assume every one of us understand it already. Because we have 9,500 people on this call. So I intentionally want to be calling randomly. Okay, you're welcome, ma.
Good afternoon. Good evening. Sorry,
Name.
I dropped my phone.
All right. So what do you understand by the word asset? We're still waiting for you.
Can you hear me?
We can all hear you.
Okay, you said you are still waiting for me now. That's why I asked, can you hear me? So
Yes.
I'll say they are like things that are controlled by probably a company or individual, like maybe a resources, or there are resources that are controlled by companies or individual.
No. I believe you you
No, I
attempted it.
joined late. I joined the group late, so I did not attempt it. I didn't even know that you dropped something of such in the group.
All right, no problem.
This is my
Mr.
first class.
All right, you've tried. Thank you for your contribution.
Mm.
Mrs. Aisha Kaide said she's unable to mute her mic. All right, that would be network problem. Not to waste much of our time. Assets are resources controlled by the entity. I just need that cogent word. They are resources controlled by the entity. Neither I don't want to answer. Hey, I don't want to waste time. That's why I know I could have called people. Most people here will want to answer. I know that. So just please let us continue. For all that we've not been like maybe one or two we've been busy and we do not by now know the definition of an asset or liability, please I will advise by now we shouldn't be going back to that. Even I don't need to like call people. If I call you, like it should just the beginning to me. Please, for those of us that are yet to understand that, please let us read it. So what we're saying is that assets are what they are resources controlled by the entity. Resources in the sense that they are everything that the company has right to control. They have power over them. They have power to control them for their use. They can control them. They can make decision on how best to treat them. They can make decision on, oh, we're using this thing today, we're not using it tomorrow. They have final say on them. Their resources controlled by them. They have absolute control over them. Their assets. Not only them having control over them, if you have control over it, what is the implication of your control? Is your control generating income for you? I mean, does it lead to an inflow of economic benefit to you as a company, or an outflow economic, or an embodiment of outflow to you as a company or as an individual? That is how you define your asset. Is it an asset to us? Oh, it's an asset. How do we recognize an asset? We did recognition criteria last week, so I'm not going to go back to that. So I'm saying an asset, you must know, oh, these are resources controlled by the entity. They are what? They are resources controlled by the entity from which economic benefits are expected to flow into the entity. So that is what an asset is. You have an asset and you have to determine you have an asset that is being used by you. Being used by you means that you don't need to take an authorization. You don't need to you don't need someone's approval before you can use it. That is why there are resources controlled by the entity. As a result of past events, you actually purchased this asset. You have them in your company's premises already. As a result of past event, a transaction you've entered in the past, and from which future economic benefits are expected to flow to the entity. Future economic benefit in the sense that you've gotten this asset last year. Over the years, you use them this year, you use them next year to what? To generate income. You use them to power. For example, you have a generator that you purchased last year. You use them to what? You use them for your manufacturing. Like, oh, you use them when you use generator. You use them to maybe in your production process to power those machines to ensure that there's electricity. To do this, to do that. from which it as a result of past events, a past transaction that you've actually entered into. You purchased this thing last year, you purchased this thing last month, and from which future economic benefits are expected to flow to the entity. That's an asset. Liability is the same thing. They are present obligation. What are obligation? Obligation are debts. They are something you are committed to. Liability are present obligation of an entity arising from past events. Are we together? They are present obligation of an entity arising from past events, the settlement of which, the word settlement in the sense that we said they are obligation. They are obligation that arise as a result of past events. Now you want to settle them. The settlement of which is expected to result in an outflow from the entity's resources. That is, it's a debt on you as a company. Now, it has happened in the past. You are now ready to what? You are now ready to pay them. The settlement of that liability is going to lead to a decrease in your cash or in your bank balance. I'm not going to say more like that for liability. Please let us wait for that. So tonight, what are we explaining? We're explaining accounting equation. So whatever assets that you have, the summation of your equity and liability must give you the totality of your assets. Assets are those things that are being controlled by the entity. They are being used to generate income. These are the things we use to generate income. There's something we call ROA, return on assets. Return on assets. That is to check that how many times as the company uses their assets in generating revenue. We're not going to that. So this is explaining just a simple task to us, like, oh, whatever assets you have as a company, your liability and your equity must equal to your assets. So we're seeing accounting equation and a business entity concept. By now, I believe we should understand the meaning of business entity. We explained entity concept the last time. That is, it's a concept in accounting that separates the business from its owner. So yeah, they're just trying to give us an example. They're trying to give us an example of an accounting equation. They said, George set up a business. The name of the business is George Security Services. Hey, George Security Services. And put some capital into the business. What is he saying is that, my name is Hafiz. I'm starting a new business. I plan to call this business Hafiz Entertainment Services. Now, to start this business, I withdrew money from my bank account, my personal savings, and I injected this money into the business. It's a capital. That is what? That is an equity. So, what they're saying is that your asset must be equal to your liability, right? For example, now, I've injected a sum of 1 minute. All right. So this is a business I'm trying to start. So we said asset must be equal to liability. Now, a business I'm starting, I believe that I believe that it's a new business. I'm not owing anybody yet, right? So now I injected a sum of 50,000 naira into my business. The money I injected is a capital, right? It's a capital. And your capital will be what? Your capital will be credited. We're still going to double entry principle. So, and your capital will be what? Your capital is credited. So now, this capital that is credited, when it's entered, my bank account is different from the company's account. That was when I was explaining entity concept. That is, the owner of the business is different from the business itself. So, it enters the company's bank account. Let's say the company's bank account. When it enters, the company's bank account is the receiver. He receives the sum of what? The sum of 50,000. And the sum of 50,000 that this company bank account receives, so the company is what? Is an asset. This 50,000 is an asset to the company. Then we what? Then we debit it. If you're looking at this, 50 year, I have a capital of 50 and I have an asset of 50. This one is an equity, while this is an asset. You see, the assets, this is what the equation is telling us. The assets here is equal to what? Is equal to equity. You're not seeing? Are you talking to me?
Yes, I'm not seeing the.
That must be your network. Is there anyone else that could not see my system? Can I see my screen?
I can't see either.
My God.
It's not showing the document.
No, he's not presenting on Excel, not the document.
So you're saying you can see the document, but you cannot see the Excel, right?
Yes.
I can see it clearly.
You can see both.
I can't see the Excel.
You can see the both. You can see both now.
It's clear. It's clear. We can see it.
For those that could not see, probably your network. Can you confirm that you can see both now?
You can see now.
Yes.
See.
So can I proceed?
I can see too.
Yeah, proceed.
All right. Thank you. So now that everyone can see my screen, what I've explained so far is simple. I said a company, I have a company, I own the company now, and I injected a capital of 50,000. It's an equity. Now, that 50,000 I injected into this business, it's going to where? It's going into the company's bank account as 50,000 here. That is why double entry principle is telling us that for every debit entry, there must be a corresponding credit entry. We're still coming to that, please. I don't want to bother us with so many information. That I'm trying to start from the foundation. We're still coming to double entry principle. So that is what the accounting equation is saying, like your asset is equal to your what? Equal to your liability and equity. So that is that about that. So this is saying, this information that we have here as an example is saying, George, the accounting system of the business will consider George Security as an entity on its own, separate from the George. And George is the owner of the business that owns the capital. That one has been explained to us. So you can see now, they say assets 30,000 and equity 30,000. That is, your asset is now equal to your what? Equal to your equity. This has been explained. So another situation whereby, this is another example here that I would like to explain to us. This one is saying Adeyemi borrows 40,000 naira from his brother. Now, should I say we should unmute our mic? Okay, Adeyemi borrows 40,000 from his brother to purchase a motor van for the business. Now, I'm going to ask this question and I'm going to call someone. Mr. Udo, can you please unmute your mic? Adeyemi borrows 40,000 from his brother. Adeyemi borrows, you can see my screen, I believe. Aremu borrows 40,000 naira from his brother to purchase a motor van for the business. What is your understanding of this transaction?
Good evening, all. Can you hear me?
We can hear you. Good evening.
Okay. The borrowed, what I understand is that there is a particular transaction in terms of borrow loan.
Okay.
Will come on a part of the liability. Then he used it to purchase motor vehicle. And that motor vehicle that he borrowed is an asset under non-current asset.
Okay.
That is the loan, the amount of the asset that he purchased with the amount is an asset, and the asset is non-current asset. Why? On the liability side, a loan will be open, a loan account. When you now look at the equation, asset is equal to capital or equity plus liability. There's no anything like capital. The capital will be okay, the capital he brought into the business is still 50, while the cash will be 50. Another asset is open, which is motor vehicle, or sorry, motor van, which is the amount, then the loan account. When you now total both the asset and the capital plus the liability, it will now give us the total balance that equate the accounting equation. Thank you.
Thank you. Thank you. Thank you. Thank you. Thank you. I love that. Mr. Odo, you've really tried. And I want to explain again for understanding sake. You can mute your mic now. This question is saying, Adeyemi borrows 40,000 naira from his brother to purchase a motor van for the business. That transaction is well explanatory. It's self-explanatory. Who is that? Yes, we say Adeyemi borrows 40,000. Fine. When you borrow, I'm going to ask from the definition of asset and liability that we have. We said liabilities are what? Are present obligation, which arises as a result of past event. Adeyemi borrows 40,000 from his brother. He borrows. That's a loan. A loan is a what? A loan is a liability. It's an obligation that you are committed to pay either now or at a later date, depending on the agreement with his brother. Now, a loan. This transaction is going to be splitted so that we understand. In this transaction, we have an element of loan. Borrows 40,000. That's the loan that he borrowed. 40,000 loan. Oh yeah, tell me, a loan is what? A loan is a liability, and a liability will be what? A liability will be credited. I'm still going to give us the breakdown of those things that will be debited and credited. I know that can be kind of confusing, but I'm going to give us. That is when I'm done explaining all these elementary aspects. So a loan is a liability. So a loan of 40,000. That's a liability to be credited. Liability. Now, what does he use the loan to purchase? You know, when he got this loan, when Adeyemi got this loan, he got a loan of 40,000. Where will the money entered to? Where will the money enter? He got a loan from his brother. When the brother wants to pay him for this loan, he will pay somewhere. He's going to pay into what? Into Adeyemi's bank account. Let's bring this thing to a real life situation. I went to a bank to obtain a loan. Now, bank has decided, I met the criteria and everything. When they're going to pay me 40,000, it's a loan. Where will they send the money? Is it that they give me cash, or they transfer to where? Or they transfer to my bank account? Is it that they give me cash, or they transfer the money to my bank account? Then I can now go and use it for whatever I wanted to use it for. So when I obtain this loan, it's a credit entry. And when it's being paid into my bank account, bank or cash, either they give me cash or they give me bank, or they transfer to my bank account, whatever the case may be. A 40,000 naira, you debit what? You debit your bank account. A bank account is what? A bank account is an asset. So that transaction is what? 40-40. That one is closed already. Now, they now say, from his brother, he now use that money to purchase a motor van for the business. Motor van is what? Motor van is an asset, right? If you believe motor van is an asset, let me see your hand in the comment section. He purchased a motor van of 40,000 naira, which is an asset. Thank you. Which is an asset, right? When he's paying for this motor van, where is he paying from? He's paying from his bank. Is it not cash or his bank account of 40,000? Now, the bank account will now be credited. If we look at this transaction very well, this is what? You know, it's an asset. We debit this now because he has paid. If we look at this transaction now, this 40 in the bank and this 40 here has net off each other because this is an outflow. in your bank account, the one here is an outflow, while the one here is an inflow. This, and he has 40,000 naira, the one he got as a loan, and he paid 40,000 naira for the motor van. These two net, they will net off each other. That one is cancelled. That one is what? That one net off each other. And we also have motor van and the loan. The loan that he got was the one that was used to secure this motor van. That is as simple as that. Don't convince yourself. I understand that the misunderstanding might actually come from which one. How do we know the one to debit and the one to credit? I'll still come to that. So all these are just explaining to us the account to debit and the account to credit. So I will implore us to go further and check all these things we have here. Instances whereby we have what? We have goods that are purchased on credit, or goods that were actually acquired using cash. The treatment is different. But before I go into that, I want to come back to this one. I want to give us what we call double entry principle. I think that should aid our understanding on this counting equation very well. I believe someone is writing. Double entry principle. Double entry principle. What do we mean by double entry principle? Double entry principle, it has double entry, sorry, let me put it double entry. Double entry has its principle. What is the principle of double entry? The principle of double entry is that for every debit entry, there must be a corresponding for every debit, it's debit, not double. For every debit entry, there must be a corresponding credit entry. That is one. Number two is the same thing. For just interchange it, as we have debit entry first, the same thing we have for every credit entry. For every credit entry, there must be a corresponding debit entry. So this is telling us that whatever transaction you are carrying out must have two entries. That is, all transactions must have two entries, because it is believed that if whether your transaction leads to an inflow or an outflow, if you enter into a transaction, one thing must happen. Oh, I enter into this transaction with Mr. There's a transaction between Mr. Udo and Mrs. Yusuf Najat. So Najat went to purchase a Mercedes-Benz from Mr. Udo. Najat is the one purchasing this Mercedes-Benz. When she's paying, what will happen to her bank account? If she has 10 million naira before and she purchased a Mercedes-Benz for 1 million naira, our bank account, there's going to be a depletion in our bank balance, because she is paying Mr. Udo for the purchase of the motor vehicle. That is what this is saying. That is, for every debit entry, there must be a corresponding credit entry. Now, Yusuf went to Mr. Udo to purchase a motor vehicle. He is paying Mr. Udo from his bank account. If she has 10 million naira before, there's going to be a depletion in her bank account. Why our own bank account is getting decreased, Mr. Udo bank account will be what? It will be increasing, because it is believed that when Mr. Udo receives the money, he is transferring the money into his bank account, or he decided to keep the money as a cash. So the decrement in Yusuf bank account is leading to an increase in Mr. Udo's account. That is what this is saying. Like, for every debit entry, there must be a corresponding credit. That is not even this corresponding. I'm just saying, like, whatever that leads to an outflow in someone's account, there must be a corresponding inflow in another person's account. Now, for every debit entry, now, I was going to explain that Najat went to purchase a motor vehicle. A motor vehicle is a what? Is an asset, which is expected to be what? A motor vehicle is an asset. Motor vehicle is an asset, right? This will be what? This will be debited. He went to purchase the motor vehicle. She went to purchase the motor vehicle. Which is an asset. Now, it has led to what? This is leading to an inflow to her because she's receiving a motor vehicle. This is what she went to purchase. What will now be the corresponding credit entry of this transaction? Because I said all transactions must have what? Must have two entries. The first entry of the motor vehicle that she went to purchase is that she's debiting her what? She's debiting her motor vehicle account. Now, what will be the corresponding? Where the corresponding entry will now be when she buy this motor vehicle. When she bought this motor vehicle, where does she pay from? Is she owing or she's paying? Now, that poses two questions to the mind of an accountant. Number one is that, a company named Najat went to purchase a motor vehicle. Fine. If, for example, in their garage, they have two motor vehicles before, they bought a new one. That means their motor vehicle is going to increase into 3. That's an increment. That's an asset. Now, the next question is that, are you sure that this company actually paid for the motor vehicle? Yes, they paid. If the company paid for this motor vehicle, what happens to their bank accounts? Either they pay bank or cash, whatever they use. So now, when they pay, how do they pay? Do they pay with cash or they pay from their bank account? Oh, this company paid from their bank account. Now, a bank account, it's an asset to them. That's their bank account is an asset. But what they want to acquire leads to an outflow of economic benefit. That means their bank account will be credited. Now, this is an instance whereby this company is paying. Now, instance whereby the company is buying on credit. That is, my name is Afis. I went to Yusuf and Co. to purchase shirts. Now, I'm buying shirts. For example, it's an asset to me. Something like this. So let's say I went to purchase, let's say inventory. It's an item I wanted to be selling. I want to purchase an inventory, my inventory is debited. Now, I'm not paying them. I decided not to pay Najat. I'll be paying on a later date. No, market has not been fine these days, so I decided to pay on a later date. Now, in your book, double entry is saying, with the fact that you're not paying immediately, you need to record it in your book as what? As a payable. That is, you must acknowledge the fact that you are owing this supplier. How do we now record that? You record it as what? As a payable. Or creditor. Creditor is the same thing as payable. So when you record that, you put it on credit. Now, you see your double entry as balance now. You have a debit, you have a credit. That is what this is saying us. This double entry is saying us. Whatever transaction you are entering must have two what? There must be two entries that you are going to pass. You must have a debit and a credit. Your total debit must be equal to your total debit. Now, let's say eventually I decided to pay. Oh, Mary, can you please mute your mic? Mary, can you please mute your mic? I'm still waiting for you. All right. So let's say now I eventually made some sales and I decided to pay. I want to pay this my creditor. Like I actually purchased this thing on credit. Now I decided to pay. When I'm paying either cash or from my bank account. Now my bank or cash anyhow is going to what? Is going to decrease. You decrease by what? You credit it. Debtor, sorry, my payable here that is showing a credit. Now I'll come there because in my book I've already shown that I'm owing Mr. Labaja, who is a creditor. Now that I've paid him, I'm going to record. I'm no longer paying by what? By debiting that account. Let's say now the inventory I purchased here is 4,000 naira from Mr. Ade for 4,000 naira. Now that I have some cash, I decided to pay that 4,000 naira. My creditor now that I decided to, that I have shown in my book that I'm owing 4,000 naira. Now I need to show that I'm no longer owing Mr. Ade because I've paid. So this is showing that a creditor here 4,000 and a creditor here debit 4,000 will give us what? It's going to give us a nil balance. If we are using a T format, there's something in accounting we call T format. A T format. How can I draw this T format? Oh, table. Okay. This is how a T format looks like. It's the same thing as T. A T format always looks like this. Yes. So this is it. I believe we can see my screen now. Can we see? So this will be debit. Why not doctor? Why this should be credit? So let's say now I claim that I'm owing this. If you post all this in double entry in a T format rather, a loan, you say a loan is credited, a loan, for example, 40,000. The corresponding entry is what? You said it's a cash or bank of that 40,000. If I sum up this is going to give me 40. Why this is also going to give me what? 40. Can you see now? This is it. So this is a debit. The all here is a debit, while the all here is a credit. If you sum up these two, whatever we have here, whatever we have, they must give us the same thing. That is what double entry is saying. For every corresponding entry, for every debit entry, there must be a corresponding debit entry, and what? And vice versa. I believe someone has written something down. Hello?
Yes.
Yes, sir.
All right. So, I want to give us, what should I say? Have I given us the definition of double entry? Okay. What we're saying, we'll be saying double entry, we mentioned the principle. How can we, let's try and depict definition from this double entry. When we say double entry, what do we mean by double entry? A double entry, we can say double entry is a system of accounting. Okay, it's a system of bookkeeping, yes. It's a system of bookkeeping where every financial transaction, is recorded or are recorded at least that's two accounts are recorded in at least two accounts. What does this mean? I said for every transaction that the company is entering into must be recorded in at least two accounts. That is, the account that will capture the debit and the one that will capture the debit. Are we together? So that is what double entry is telling us. That this one is, what does this double entry actually help an organization to do? Like, it helps them to be able to keep adequate record of all their inflows and their outflows, ensuring accuracy, and it actually helps in preventing fraud. Again, a double entry principle is a system that is being used to provide check and balances for each transaction. Okay, it is a system that provides a check and balances for each transaction. Yusuf, Nadia, are you on this call? Nadia, are you on this call? No. So I'm going to choose someone else. Oh, Mr. Udo. Mr. Udo, are you here? No.
Yeah, I'm there.
Okay,
I'm
please.
there.
There's a small task I want to give to you. Please, you can go to the platform. You can type it there. Like, for those that are sending message that they couldn't join this section, they should join the YouTube class. If you're not able to join the Google link, please join the YouTube class. If they keep calling my phone like this, my phone is connected to the internet, so to just be disturbing my network. If you're not able to join the Google link, join the YouTube link. Thank you. Thank you, sir. So we can continue. Mr. Odo will do justice to that. those that are falling. So that is what this double entry is trying to explain to us. So now, in accounting, you know, there are 5 types of accounts that are being used in double entry bookkeeping. So all these notes are something that will help us when you see, I'm not using the material now. I'm talking of FA study pack. The reason why I'm not using that is because I don't just want us to jump into seeing questions. And so please, all these, let's take note of them because we're going to use them to solve whatever question that comes our way. So I said there are 5 types. Yes, 5 types of accounts. Not 4. Let's talk about using double entry in double entry bookkeeping. When we say 5 types of accounts that are being used in double entry principle, that is what the class of account, you call it type, you call it class of account that you'll be seeing in double entry. It includes number 1, we have assets. You'll be seeing asset accounts. You'll be seeing liability accounts. You'll be seeing, you should be giving me now. Which other one? You'll be seeing income accounts. Who is that? You'll be seeing income account. What again?
Equity.
Okay, you'll be seeing equity. Which one again?
Expenses.
Expenses.
Thank you. Expenses account. I love it. So by now, I believe we understand the asset account. Or you want me to explain again? So I explained asset already, are resources controlled by the entity. So asset accounts here that you'll be seeing as far as double entry is concerned, we already say asset are resources controlled by the entity as a result of past events, which are expected to bring an inflow of economic benefit into the entity. Fine. But when we're talking of resources, as we said, they represent resources controlled by the entity. Example of these assets, we have cash. You'll be seeing cash, you'll be seeing bank, you'll be seeing inventory, you'll be seeing equipment. If you have additional, what's it called? Please add. I think this is okay. For liability, what do we call liability? We say liability are what they are present obligation which arises as a result of past events, the settlement of which are expected to lead to an outflow of economic benefit. Okay, these ones, we can say these ones represent the debts of company, of an entity. Okay, or debt or obligation. Obligation or debt also. Anyhow. Obligations of an entity. Oh yeah, example of liability.
Loan.
Loan.
Rent.
Wait. I've had loans. Fine, accepted. Someone said the rent.
Yes.
I want to know why liability.
Probably
I'm
maybe
coming. One after the other.
please. Okay.
One after the other.
Cash. Cash.
Someone is saying
Cash.
something. Who is saying cash? Who are these people now? Wait, I want to see people's face. Who gave me rent? Someone mentioned rent. I only want that person to unmute his mic. About today, are you the one? If it's not, you please mute your mic.
No.
Yeah, someone said rent. I need to clarify that.
Hi, sir.
Okay, Mr. Tai. So
Yes,
why
sir.
do you say rent? Why do you think rent is a liability?
Possibly if the company is
Let's see
renting
or say
their
thank
space.
you.
Sir?
I can hear you. Continue, sir.
Okay, if the company is renting their office space or their warehouse, if it's not a property owned by the company and they are obligated to pay it probably yearly.
Thank you. Thank you. I like that. But you know that we are saying we know it's going to lead to an outflow of economic benefit. But at the same time, they will be classified either as an expenses on the company. So those ones rent for warehouse or whatever will be classified under expenses because you know whatever they are using it for is for the purpose of the business, and you want to determine tax payable. Tax payable is under payable, Mr. Olawaju Mike. I'll come back to that. So let me explain this, please. Mr. Ojo, are you getting me? You know, the rent that you are paying for your office space is something that is tailored to revenue generation for the period that it occurred. For example, now you are paying a rent of 10 million naira. You want to know, like, after payment of this my rent, and I make revenue, I made a total sales of 20 million. How much is left for me? That is why you classify it as a current expenses under your profit or loss, and it will not come into your liability. There are some instances whereby that rent will now be captured under liability. The instances whereby that payment, whereby that rent will be captured under your liability is when you do not pay it on time. Let's say a rent for this year now, okay, a rent for last year now has not been paid. You know, last year account, the rent has already been captured in the profit or loss for last year, but you do not pay it. You have to recognize it as a payable in your book because you are owing it. It has turned to what? It has turned to an accrual. I believe you understand that. Thank you. So someone else said, so all those accrual, whatever tax payable that people are mentioning, they will fall under your payable. They will fall under what? They will fall under your payable account. You can now split it anyhow. Your tax payable, your clinical payable, your trade payable. You can split it anyhow. Staff payable, even some companies have staff payable because some of their staff will get loan from them, loan and advances from staff. Someone else mentioned prepayments. You cannot, prepayment is not, Mikey Akinyemi, prepayment is not a liability. What do we mean by prepayment? Prepayment is a service you paid for in which the benefit is yet to be enjoyed. If you mean a prepayment by your customer, you will not call it a prepayment again. You can say advances from customer. If you now say bad debt, okay, bad debt is an expense, sir. All those ones are expenses. We are still coming to expenses. Please don't mix liability to expenses. Creditors, fine. For prepayment, prepayment are services you paid for in which the benefit is yet to be enjoyed. That is prepayment. So it's an asset to you and not a liability. So it's an instances whereby your customer now paid in advance. That will now be a debt on you. That will be a debt on you. But prepayment is what you make, which the service in which you are here to enjoy. Cash deposits from customer, yes, that's the right word for the prepayment from customer. Bank overdraft, thank you. The bank overdraft is also a liability. So let's continue. Loans, we've mentioned loans, Mr. Bashira. I said Mr. Bashira, Mrs. Bashira. Thank you. So we have account payable. Account, let me put it as account payables. So whatever payables you want to add, put it. So income accounts. What are income? What does income account represent? From those people that give us definition during our assignment. So income accounts are, not to waste time. This represents the revenue. What is revenue? Can someone give me the meaning of revenue? Another word for revenue. Revenue of an entity.
Sir, can I speak, sir?
You can speak.
Okay, those are incomes collected from goods sold out.
Thank you. They are sales, such as sales and let's say interest income. Revenue is the same thing as sales, though. So, oh, okay, which one again? Equity. What are equity? We explained the other time, like someone injected a fund into the business. That's part of the equity. Equities are capital. They are the fund invested in a business. They are the fund injected. Is either used injected or invested into the business. Some people call it what they call it, shareholders portion of the business or shareholders contribution to the business. Anyhow, anyone you call it. This represents the amount invested into the business. It might not, I don't want to put by the business owner, because now you can decide to go and meet a godfather that actually invests in your business. It's also a capital. Represents so example, you can capital. So expenses now, our understanding of expenses. These includes the cost of running a business. Let me put in these shorts. Cost of running a business. So now someone mentioned what's it called the other time? Rent. Rent is part of it. You have rent, you have utilities. There are so many expenses that you incur during your day-to-day running of the behind. You incur in your day-to-day running of the business. I expect us to list as many as the ones in our book. Rent, utilities, what again? What again?
Posted.
Salaries and wages, insurance, thank you. Depreciation, yes.
Salaries.
I didn't hear you. Transportation, fine. So just list them like that. Just balance the definition or whatever. I'll just pick, someone mention salaries and wages. Transport and traveling. etc. You can add them up. So another thing I'm going to give us now is how do we know the account to be debited and the one to be credited? But before we go to that, let's try and give us a short note on the advantages of double entry. Why do we use this double entry? I think I mentioned some for transparency the other time. Advantages of double entry. Can someone help us? You are not saying anything. Why?
It helps to control fraud in the company.
Thank you. Thank you. Let's be writing like that. The writing.
Also, it's to ensure the accuracy of the accounting system.
Thank you. I like this thing being echo like this. Thank you. Oh yeah.
It also gives complete financial picture.
It helps us to what? It helps us to what?
It helps us to trace financial transactions.
To trace
financial transactions.
To trace financial.
It helps to keep or provide checks and balances.
Okay. Wait. So far, I've had people saying one. Let's take that as well. I'm not saying the one, whatever you've written, you should cancel it. The only one I don't think I get right is the one that said it helps us to trace something. Yeah. Hello? Hello?
Hello.
Hi, hello.
Hello, sir.
Yes.
Yeah,
So,
we can
number
hear
one,
you.
someone mentioned,
Hello, sir. I said it helps us to trace financial transactions.
yes, Mr. Dauda Adam, you said it helps us to trace financial transaction. Trace,
Yes, sir.
fine, I will accept that. But at the same time, you know, if you're saying to trace financial transaction, why are we tracing it? Let me try and add some flesh to that. So it helps us to trace financial transaction in order to gain a clear picture of the company's financial position. Because if you are tracing transaction, where are we tracing it to? Why are we tracing it? So it helps us to trace financial transaction in order to gain a clear picture of a company's financial position. For check and balances, fine. To avoid double posting, still part of it. To detect error and fraud, still part of it. To use of double entry. Improve cash flow management. Yes. Yes. Helps to prevent fraudulent practice. It's the same thing we mentioned that. So I think we mentioned like 4 to 5. Complete financial picture. Fine. Accuracy, transparency. You've all done well. You've all done well. It helps us to know the total inflow and total outflow. That is accuracy. That is also part of the clear picture of the company's financial position. So thank you for those advantages and disadvantages. Advantages. So now I'm going to move into explanation of how double entry works in real life. Sorry. How does it work? We're just mentioning the one, this one is this one is that. How does it work? So this is how this thing works. I want us to write this down because what's that? Please, Udo, can you please mute yourself? I'm still waiting for you. Please, Udo. All right. So now these are the things we need to know. We've said for every double entry there must be a corresponding. So when you are doing your double entry, this is one knowledge that is being used in our preparation of trial balance. What is trial balance? Now, you see, I didn't jump to trial balance because I know this is a knowledge that we need in preparation of our trial balance. So what is a trial balance? A trial balance
Can't hear you, please.
You can't hear me? Are you talking to me?
I can hear you now.
Yes.
I
So
can
I
hear
said,
you now, but
I said, double entry knowledge is an important knowledge that is needed in the preparation of a trial balance and also preparation of an account, because an account preparation starts from trial balance. Because if your trial balance does not balance, there's no how you're going to have a well-prepared financial statement. Once your trial balance is okay, trust me, what you need is just to post. Once your posting on the trial balance is perfect, you don't have a problem anymore. So what is a trial balance? A trial balance is a list of balances. It is a list. A trial balance is a list. Is a list of balances extracted from the ledger to show the arithmetic extracted from the ledger to show the arithmetic accuracy of the account. Arithmetic accuracy in the account. So what does this mean? What this is saying is that a trial balance is a list of balances. It's a list of balances in the sense that whatever balance we have from our sales day book, whatever balance we have from our purchases day book, whatever balance we have from our motor vehicle account, and every other transaction that occurred will now be moved, will now be extracted, and show in our trial balance. Since in our daily transaction we have debit, we have credit. At the end of the day in our trial balance, our total debit must be equal to our total credit. So in posting, these are the things we need to know. So I'm going to mention them. When you are posting in double entry, the account will be posted, the account will be debited, and the account to be credited include, if you want to debit an account, you should know that purchases, if your company is buying anything, purchases is to be debited. Why sales is to be what? Sales is to be credited. Income, sales actually are what leads to an income. Sales are to be what? Sales are to be what? Are to be credited. So a situation where we are seeing a sales on the debit side, that's the problem. Is that there has been a sales return. Maybe they return sales and you need to refund their money back to them. Then what? You debit assets. You debit assets, you credit purchases. Expenses, income, expenses are debited. So whenever you see all these accounts on the other side, you are seeing purchases credited, that means it's a deployment or a depletion of the purchases, which might have occurred as a result of you returning some goods that you actually purchased before. Is someone getting me? Hello?
Yes, sir.
Do we have any question before I move back to the material? No one is saying anything.
I have a question I want to ask.
You can write down, sir.
Can we say accounting equation is synonymous to duality concept of accounting?
Yes, you can.
Okay.
But I will throw the question back to you before you go. What do you understand by the word duality in accounting?
At the name dual is a concept that recognizes two sides of every transaction. They can call it duality concept or dual aspect concept of accounting that states that all accounting transactions must have two sides, asset or liability, income or an expense. That is what the concept said. Because there's a question on the pack that said accounting equation which of the concept of the accounting equation? That is why I asked that question. Is it a duality or dual aspect concept? That is why I asked the question. Thank you.
Thank you. You ask the question and you explain also. I like that. So the question you asked about the duality, a duality concept, they are one of the concepts that are no, I don't want to say they are no longer in use or something, because we have better things that actually take place of them. That was why I was saying a double entry for every debit entry must be a corresponding credit entry. Then every transaction has two sides. Dual means you see it here, you see it here. That is, there's a debit here, there's a corresponding credit here. We've explained all those things. It's just an English word, a dual concept, duality concept. So the concept that actually matches that is that. Thank you. I believe that explains your question further. Thank you for that. So we'll be moving back to the material, and I believe that they should have some questions we can actually touch. And if there's no question there, trust me to give you an assignment tonight. There's going to be an assignment. So, is there another question? This is 9:40. I need to leave the office. So this class ends by 10:20. So what's your question, Mr. Adamu?
Yes, I want to get it more clearer whether we can classify account payable as an asset.
Thank you. One thing we need to know is that before you can classify any account or any transaction as an asset or liability, we gave ourselves, that was why we're coming from the foundational aspect of accounting. Last class, I was explaining something about recognition criteria. How do you recognize an element in a financial statement? How do you know this one falls under assets? Why this falls under liability? That was the main reason for the recognition criteria. I mean the last class. But I will accept that you are not in class, and for those that are not in class also, or they need me to explain again. So the recognition criteria is saying if they meet the definition of an asset, you will recognize them as an asset as such. If the transaction meets the definition of a liability, it will be classified as such. And then that transaction must be measured reliably. That is what the recognition criteria is saying. So you now check that you said, what do you call it again? Sorry. Tax liability or payable, or what do you say? Mr. Dauda, you said you mentioned account payables.
Account payables.
Thank you. That's what I need. I needed. So account payable. What do we mean by account payable? Account payable is the same thing as creditors. That is, payables are creditors. What do we mean by payable? What do we mean by creditor? Creditor and payable are the same thing. What do we mean by creditor? A creditor is a vendor or a supplier of a business entity in which an entity is owing a certain amount of money. I use the word certain because that amount that is being owed to the contractor or supplier or vendor can be measured reliably. We know the value of the amounts being owed to this creditor. For example, I'm into the purchase, okay, I'm into the sales of, what can I even be selling? I can't even remember. Okay, I'm into the sales of a laptop. I'm into the sales of laptop. So I went to OJ Laptops and Case to supply me 30 units of HP laptop. I got there, I told them I don't have cash right now until I sell all these items off, or until I finish the sales of this item before I pay back, or I'll pay back in a month's time. They gave me 30 units of this laptop. In my own book, these items that I got from them, once I receive them, it's an inventory to me. Inventory will be debited. Why? The corresponding entry will be a payable, account payable, showing that I am owing OJK Laptops and Care for the purchase of laptop, meaning that I'm here to pay them. When you are here to pay someone, it's what? It is an obligation. What does the definition of an asset says? The definition of an asset says resources controlled by the entity as a result of past events, which are expected to bring an inflow of economic benefit. The laptop that you got is an asset to you because when you are using them at the end of the day, it is being used to generate an income to you. Now, the one you went to purchase that you are here to pay, which is a creditor, it's a liability because they are present obligation which arises from the transaction that happened between you and OJK Venture, the settlement of which is expected to lead to an outflow of economic benefits. Mr. Taiwo, I hope you get something from this elimination. You went to buy a laptop. It's an obligation for you to pay. What does an obligation mean? It's a debt that you are going to pay in. So you cannot classify that creditor as an asset. It's a liability. It's an obligation that whenever you are ready to pay, it will lead to a decrease in your cash or your bank account. You are owing me now for this service I'm running to you, and you promise to pay me when your salary drops. Your salary has not dropped, but I'm giving you this service. I'm offering this service to you at an agreement, based on the agreement that you're going to pay me next week when your salary drops. The services I'm running is lecturing. Fine. As you are getting this knowledge, it is adding value to you. An asset. It turns to an asset to you. Whenever you understand what I'm explaining in the concept of trial balance, it is something that has saved on your head that you can use to generate economic benefits at the end of the day. You can go for training, you lecture people, so you get money. It's an asset that is expected to bring a future economic benefit to you. But I that offer this service to you, you are yet to pay me. That is to show the corresponding liability aspect that you are owing a fee. So when your salary drops next week and you pay, if your salary is 1 million naira and you pay me 500,000 naira, your bank balance will surely reduce. That is how you work. That is how you measure. Is it a liability or an asset? So account payable is a liability in any day. It can never be an asset. So that is how we auditors, this is one thing we do. When we're auditing book of every company and we're seeing the accountant mistakenly, let me say mistakenly, fine. Maybe he mistakenly recorded the transaction that is meant to be on the debit side, on the credit side, with no question. Why is this? He will now start explaining. Okay, no matter what, you cannot put it on the credit side. If you know they've returned this item, treat it properly. So that is where you need to ensure that your book, to ensure accuracy in your books. This thing is a liability. It should be credited. This thing is an asset. It should be debited. Are we together? So don't let us. Another question, Mr. Dawda, I hope that answers your question. So any other question?
Yes, sir. Thank you, sir.
You're welcome. Any other question? So in the absence of question, I myself, I have question. I myself, I have question. I'm going to throw my question out to who should I throw this question to? Okay. Mrs. Teresa, please unmute your mic. Just a minute. Mrs. Teresa, unmute your mic. So let's say you have this transaction. Are you with us? Mrs. Teresa. Okay. I'm not sure she's with us. One time I've gone. Okay. What should I do? Should I call again? She's not here with us. Fine. So don't let us waste the little time we have left. So let's go back to our material. To explain how we understand debit, we understand credit. All these debit, credit. Now, I'm coming to transaction 5. Okay, we stop at transaction 3. He said, Adeyemi buys the market store and pays 5,000 naira in cash. Fine. You just need to analyze the transaction. What happens there? This thing is saying Adeyemi buys a market store. And I gave us the other time, I said, whatever you buy, whatever you purchase, purchases are to be what? Purchases are to be debit. So when you buy, this is purchases debited. When Adeyemi buys a market store, what happens? He will debit the market store because the market store is an asset to him. Adeyemi buys the market store for 5,000. When he buys 5, they said he pays 5,000 naira cash, which means if Adeyemi is having 10,000 naira cash with him before, his cash is going to be depleted into 5,000. So the entry of this is going to be you debit market store, which is an asset, and you credit cash. Simple as that. The transaction continues. Said the business has used one asset, that is cash. Okay, this is just an explanation. They said the business has used one asset, cash, to acquire a different asset store. There is no change in total assets, simply a change in makeup of the asset. As simple as that. That is, you have 50,000 naira cash. Sorry, 5,000 naira cash. And you use that, the cash that you have is an asset. You now use that cash to buy a market store. Your cash will turn to 0. Why? By you are bringing in another asset, which is what? Which is store, 5,000. Transaction 4 is saying buying asset, inventory on credit. I've explained this. And I'm going to throw this inventory on credit again. Should I throw it? We've explained all this while we're doing this explanation, but let me just. They say Adeyemi now buys some football shirt for 80,000. He buys this on credit and does not have to pay for them immediately. Now, I need someone to explain this to me based on the explanation of payable that I did to Mr. Dauda. Okay, let me look up. Mr. Dauda Musa. Is it Dauda Musa? Did I get it right? Mr. Dauda was one I explained payables to, so I would like him to explain that. Mr. Dauda, is he on this call? So in the absence of Mr. Dauda on this call, I'll call Miss Najat to explain that. What do you understand by this transaction?
Yeah, you said that person bought inventory on credit. Okay, according to the question, the person bought inventory on credit, and that's like a liability, payables. It's something that the person is definitely owing, and that means on our trial balance we are going to be debiting that because
debiting what are we debiting?
What the person bought on credit. Sorry, I didn't get the total amount.
Yes. Okay, what he bought on credit is going to. Okay, I thought I'm showing it. Let me just go back. Okay, they said he buys some football shirts. You can continue.
Yes, sir. So that's it, sir.
And what will be the corresponding credit?
The corresponding credit is going to be the total amount that is owing.
That is a liability on him. Thank you.
Yes.
So you see, once you understand the concept of debit, of liability, asset, expenses, you don't have problem. So another one is saying, what's this? Mounting a cash payment to settle a okay. Mounting a cash payment to settle a liability. That was what I explained with this Excel. Now that, let me split my screen. They said now he's mounting a cash payment to settle a liability. He's now ready to pay this liability. For example, you know what I explained here is that when this one was the first transaction as Mr. Adeyemi got a loan. When he got a loan, the money was paid into his bank account. Now he used the loan to purchase a car. Now they're saying Adeyemi pays 10,000 naira to his supplier for some of the shares he purchased. This is how this works. You know, initially, look at this thing I'm going to do now. Adeyemi, when he got the shirt, football shirt, when he got the shirt, we're going to what? We're going to debit that 80,000 naira. Then, and what? And his supplier, 80,000 naira to be credited. Now, they're telling us now that I'm going to use a T format now. In this T format now, I'm going to have a football, a shirt of 18,000, and what? And his supplier of 18,000. Now, this is the first transaction. They are now telling us that Adeyemi now pay 10,000 naira to his supplier. When he paid 10,000 naira, where is this 10,000 naira coming from? The 10,000 naira is coming from his bank account. For example, I'm just citing, it might be Banco. So let's say 10,000. This 10,000 naira is to be debit or credit. Hello?
Credit.
Thank you. It's to be credit. You know, when he's paying 10,000 naira, what is the corresponding entry of this bank? What will be the corresponding entry of this bank? The corresponding entry of this bank is not something you need to be burdening yourself. It's supplier. Who does he pay to? He's paying his supplier. Part of the money being owed to the supplier is paying him 10,000. Who is receiving now? The supplier is receiving. You debit the receiver. Now you come to this account again. Yes, you come to this account again. Now supplier. Let's say we have supplier here. 10,000. If you go to your bank account, I don't want to be drawing so many T formats. If you draw a bank account T format also, your 10,000 will be here. And this one is the supplier. The total debit is equal to total credit. That is what this thing is saying. Your total debit must be equal to your total credit at the end of the day. Now you are seeing that 10,000 here and there. So if you open a supplier account, let's try to open a supplier account. Supplier account. We're still going to come to all these opening of accounts, and the rest. You know, at first, this is a supplier account. So when he buys goods on credit from the supplier, we what? Supplier shirt. He saw it was one associate to him. What? This is a credit, right? Why this is a debit? Shirt of how much? 18,000. That is the supplier account. Now let's come down to supplier and share. This is an asset or inventory account. This was when he purchased the shirt, debit, and your credit. You know, now what does he buy? He bought a shirt. He bought a shirt for 18,000. So in this account now, this and this is a debit, this is a credit, right? Now that he paid this supplier. How much does he pay the supplier? He paid the supplier from his bank account a sum of 10,000 naira. We are going to open a bank account, a bank or cash account. Now, you know, his bank or cash account that we're going to open now, he has debit supplier. Supplier is now the receiver of the bank, of the money that he paid. A bank or cash account now will be what? Will be credited. This is all what we've been displaying. Sorry, supplier. Because if we are going to check his bank statement now, we're going to see the name of the supplier by 10,000. This is it. Now, this 10 is a debit, this is a credit. That is gone. This is a credit, this is a debit. That is gone. That is how. So let's say we are trying to now prepare our trial balance. Now, he said trial balance is a list of balances extracted from the ledger. These are ledgers. Let's look at let's find this summation, like the balance of this account. What will be the balance of this account now? Oh. Okay, now this is 18,000. The first thing you need to know is that which one is the higher? 18,000. So the total is 18,000. The total of this is what? The total of this is 18,000. Then this will now be our balance. Let's say that we are now at the end of the period. Balance, we call this balance carried. Going forward, okay, not even going to. Balance CD. Balance CD is what we call balance carried down. That is the difference between this and this is what? 8,000. That makes this one 18,000. Then you now come here to put your balance. You said balance. What would this one be? This one will be balance brought forward. 8,000 naira. This one is closed. Oh. This will be closed because it is assumed that the transaction has ended here. For this one, now if we come to our inventory account also, this is 18,000. You just come here, balance carried down 18,000. Balance brought forward 18,000. Then you come to your bank or cash. Okay. Balance carried on 18,000. Who is that? Who is that? Who is that? So balance, hey. 10,000. So what will be our balance carried down? What are we carried down? We carry down 10,000. Bank carried down. Hey, balance brought forward. Rather. From this little information now, I want to prepare our trial balance. And I said trial balance is a list of balances extracted from the ledgers. So I have my ledgers now. Let's try and extract this and see if this is going to balance or not. So I'm going to draw my my trial balance. Okay, so my people, let's start from the first thing that we have here. So this is not part of what we're doing. We started from supplier, Abby. Supplier. Supplier is what? Is a payable, Abby. Is someone following me?
Yes, please.
Supplier is a payable. What is the balance we have on supplier? Is it a debit balance or a credit balance? This explains all what I've been saying since. I said supplier, payables, creditor will have a credit balance. Abby, this explains everything. Now, from this that we have here now, this is the ledger of supplier. What balance does it show? Is it a debit balance or a credit balance?
Credit balance.
A credit.
Wait. Don't bombard me. If you are in support of debit balance, let me see your hand. Okay, just type your what should be the balance. Just type in the comment section. Let me see. You can't see my screen, okay? Ah, God. Why now? Mr. Tokpa, please check your network. So, Mr. Sheon, credit. Why people say credit? Mr. Debite, I like this. Oh. All right.
Supplier is a debit balance, while payable is a credit balance.
Mr. Odo, all right, I'm coming. Please, guys, can you give me just a minute? I need to pick this call. Sorry. All right, I think I'll have to pick. I'll have to call back later. So, okay. It's okay. Let me start from Mr. Udo. We said supplier is a debit balance, while payable is a credit balance. No, you're wrong. This is a supplier account in our own book. A supplier are those that give us goods on credit. It is a credit balance. You are looking at this balance carried down. Whatever balance you're going to see, I said balance brought forward. That is, after the transaction that occurred between these people and these people, we have a balance brought forward of 8,000, and it's showing a credit entry, meaning that we are still owing this supplier. That is what translates. That is what this transaction translates to. There's nothing like supplier is a debit balance while payable is a credit balance. No. A supplier account in this instance now is showing a credit balance because the balance brought forward. Brought forward means that at the end of this period, what we are transferring into our balance is a credit balance. So I will now come here. I will now say supplier. If you like, call it payables. If you like, call it creditors. Anyone. Supplier is a credit balance of 8,000. Is it 80? Which is 80. Is it 80? It's 8 now. 8,000. So that is supplier. Now, inventory. Is inventory a debit balance or a credit balance? Let me see your hand. Okay. Is it a debit balance? Debit balance inventory of how much? Of 18,000. This is 8,000. Now, cash and bank balance, is it a debit or a credit balance?
Credit balance.
A credit balance. Please, I need that person that says debit credit balance. I don't omit your mic yet. I have a question for you. I'm even coming back to this. I have a question for you. Now, when we have a cash or bank balance on a credit side, what does this mean?
Sir? Cash or bank or cash balance?
On a credit balance, what does that mean? Let me explain something to every one of us. Accounting is so sweet that it's actually revolve around our day-to-day operation, day-to-day activities. So whenever you have a debit, someone raised hand just now. Is someone raising hand to explain that? All right. So you are seeing your bank account having a credit balance. Okay, can I? Okay, yeah.
Actually, it's not for your question. It's the previous
like
question
that.
I want to ask.
You want to ask question?
Yes.
Yeah,
the previous one.
What's the question?
Okay,
a nice one. I like that. Abasiama, thank you. That's it. That's the explanation. Oh, yeah,
so,
Mr. Ward. Mrs. Sorry.
No, Miss. I wanted to clarify something. Like, in some questions whereby the creditors or the suppliers, whereby it's an individual account, like a personal account, like a name is given, like say Kabirat, we bought from Kabirat, we purchased it from Kabirat. So in that cases, we open an individual account for such person. Then when we want to prepare our trial balance, we either do a receivable account or a payable account. I just want to understand that part. Like, is it that way, or we just open a payable and receivable account from the onset? I'm asking for in a situation whereby we are giving exam questions.
Scenario, I understand you.
Yeah. So yes,
I get your question
now.
I get your question. So this thing is not hard. You will say, for example, said goods purchased from Wurola on credit. It is obvious, and we all understand that you are buying on credit from Wurola. Wurola is a creditor. You can put it creditor in brackets Wurola. You can put it Wurola in brackets creditor if you like. State it there. But the accounting term of Wurola in that transaction instance is a creditor. Wurola is just an individual account, and that is what accounting is telling us, that Wurola, except if Wurola is the name of the company. We've told us in the past that Dangote is different from the Dangote cement that we know, because individual is different from their business. That is entity concept in accounting. So the fact that Wurola is the owner of the business doesn't mean the name of the company must be Wurola Enterprise. If it's Wurola Enterprise, fine. Wurola Enterprise, it shows a credit. You can put it at the front in brackets, creditor or supplier. You are getting your mark. And if you choose to put Wurola, in as much your posting is right, you don't have a problem. Thank you. So, questions, sir. Oh, time. Okay, let me explain this before we go to question. Please, let me explain this. So, Naima has actually given us the reason why your cash balance is showing a credit. Whenever you are seeing a credit entry in your bank, it means an overdraft. What does an overdraft mean? Overdraft means that you have actually withdrawn more than what you have with the bank. Your bank account is 15 naira. Some of us now, our bank account is showing minus 13. Someone like me. So minus 13 means with the whole bank, 13 naira. So that is it. It means that we are owing back. It's an overdraft. A bank account cannot have a credit balance. Don't be confused so that you be saying, oh, I got a credit alert. An accountant if we should explain the meaning of credit alert that you get, like why are we not saying I got a debit alert? Because we believe that a debit alert is the one that impacts inflow, that is increase in your bank balance, while the credit is the one that shows outflow. But in banking term, a credit means an inflow, while a debit means an outflow. If I should be explaining that now, we don't have the time, but I will use 1 minute to explain. I'm not saying you should understand this or not. I'm just going to explain in 1 minute. What does that mean? When we say, oh, who will transfer money to my account, I'm going to receive a credit alert, which means my bank balance has increased. It's minus 13 before. Now, if she transfer 20 naira, I'll be having 7 naira. That is an inflow. But what does that credit actually mean in the real sense? It means that I have a bank account with UBA. Whatever money I have in my bank account with UBA means that UBA is owing me. I don't think someone is getting it. It means that UBA is owing me because it's like I kept my money with UBA. Bugola is a UBA bank, for example. Bugola is the owner of UBA. Now I open an account with UBA. My brother now transfer money to my bank, to my UBA account. Who owns the money? I'm the owner of the money. For UBA, they are the one managing my fund on my behalf. It's a debt on UBA. It's a debt on UBA because nothing must do my money. Because it's a debt on them, that is why it is being recorded as a credit. That is how you get a credit alert, because UBA is in debt of your money. So when you now withdraw from the money, you will be like, thank God, bro, we are owing you 20 naira before, he has gotten 5 naira from it. Thank God our debt has reduced. That is why you get a debit alert when you withdraw. A debit alert that you get, when you get the debit, it's now coming to your own hand. A debit means that you've received it. Why a debit on the aspect of the bank means that bank, they owe you 15 naira before. Now you don't collect 10 naira. It has reduced the amount the bank is owing you. That is for the banking concept. Please don't, if you want to ask a question on that, just type it. So, Mr. Jeremiah, type your question, please. There's no more time. Type your question. So, I'm going back to this trial balance that we extracted. I said trial balance is a list of balances extracted from ledger. This has been extracted. At the end of the day, whatever debit you have must be equal to your total credit. If you're looking at this, just a small trial balance, we don't even have full question. We don't have a long trial balance. From this little, you see it as balance. The debit is showing anything why the debit is showing anything why the credit is also what? It's also showing 80. That is how it works. And there's nothing like the year has not ended. No, 80 means that it has balance. In as much you've posted the right transaction in the right place, you will have a balanced trial balance. So this trial balance will now be what you're going to use in your account at the end of the day. This is just a 3 transaction I just analyzed though. You can have a long sheet of trial balance. So I'm going to give us question, an example. First thing, you see all these ones, we've explained this one during our explanation. So I'm going to give us the account to be debited. I'm going to add another thing to this list of accounts to be debited and credited. What do we mean by drawing? A drawing is a withdrawal from the business pocket by the owner of the business for personal purpose. That is, the owner of the business actually takes out some of the goods that is being sold for his personal use, or withdraw from the company's bank account for his personal use. Anything that the owner of the business withdraw for himself, is a drawing, and it will be treated as what? As a debit entry. Because we've said that the business is different from its owner. So drawings are debited. So I explained that because I saw something on drawing in the material just now. So aside from drawing, I don't think there's any other thing that is not touched from all this. So this question I have here, it said, Joseph began trading on 1st of January 2019. The following information has been extracted from his account record as at 30th of June 2020. They said sales, purchases, salaries, motor expenses, rent, insurance, general expenses, and the rest like that. He said we should prepare a statement of profit or loss for the 6 months ended 2019 and a statement of financial position as at that date. Okay. This practice question will be given to us as an assignment. I'm going to share it to the platform now. Please just lay your hand on it. I know we've not done statement of profit or loss. I know. I just need an attempt. Or can I just quickly take us through that? Because we're still going to come to profit or loss in the next chapter. This one is just a preliminary something. Any profit or loss you'll be seeing here now. I don't want to, what should I? Okay. Can we use this to do a trial balance and see if it's going to balance? Okay, let's use this for trial balance. Now we need to be fast because some of us are still in the office and we need to get home. I need a chorus answer, so please. I don't mind. Just give it to me. Should I even? I want to believe we're not sleeping yet.
No, sir, we're not.
All right. So whenever you have a sales, is it going to be a debit or a credit entry?
Credit.
Okay. Purchases, income. What about purchases?
Debit.
Debit.
This is 290. Okay. What about salary?
Debit.
Credit.
Who is paying credit for salary?
Debit.
Let me find you. If I plug my teeth on you. Okay, motor expenses.
Debit.
Because they are outflows. Just as simple as that. You don't need to rack your head too much. Rent.
Debit.
Insurance. General expenses.
Debit.
Who is saying credit? Don't let me catch you. Premises. Wait. Who is saying credit? I want to catch someone. I know I'm going to catch you. You say credit. Oh yeah. Motor vehicle.
Debit.
Trade receivables.
Debit.
What is trade receivable?
Credit. Receivables are credit.
Wait. Calm down. Miss Funke.
Yes, sir.
Trade receivable, is it debit or credit?
Is debit.
Is credit.
Yes, thank you. Satan, don't go yet. I want others to mute their mic. Please mute your mic. Yes, thank you. Yes. Satan.
Yes, sir.
Thank you. Why is trade receivable a credit entry?
Okay. Receivables are credit entry because those are the income entity or the company is expected to receive in due time.
Yes, thank you. From your definition now, you said they are income that the entity is expected to receive in due time. What do we define assets are? We said they are resources controlled by the entity as a result of past events. Due time you use means that transaction has occurred in the past. Fine, it matches that past events, the benefit of which are expected to result to a future economic benefit. That is, due time is a future, meaning that it cannot be a credit, it is going to be a debit. You said now yourself that in due time they are going to receive it. It is going to be a future economic benefit. I hope you understand. So there's no way it's going to be a credit, it's going to be a debit, because receivable is the same thing as debtors. They are those that got goods from us on credit. They've not paid, they are going to pay. It is a debit. Are we together? Do you understand now?
Okay, sir. Okay,
Yes.
it's fine.
So now our receivable is a debit entry. And what will be our payable?
Credit.
Credit for you.
So our cash is what?
Debit.
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 Drawings is what?
Debit.
Debit.
Our capital will be what?
Credit.
Credit.
Yes, I have the calculation.
If you see now, our total debit is equal to what? Meaning that no matter how you're going to use this to prepare an account, that the account will not balance. You see now? 254, 240. So what the question is asking us to prepare a statement of profit or loss for 6 months as part of financial position. So I'm going to give us a template of statement of profit or loss as part of financial position. I'll give us the template, and I want us to go and just practice this. Because we are still coming to the recalculation. So when I get home, I will look for assignments for us and I will share all the templates. So I think this will be the end of today's class. Thank you for your time. Thank you for your audience.
I have a question, sir.
You have a question? Okay, what's the question?
Yeah, I actually typed in the group. I wanted to find out, let's say dividends are paid to shareholders. Can we categorize it as drawings from there?
Dividends are not drawings. The definition I gave as a drawing is that drawings are the money withdrawn or goods used by the owner of the business for personal use. Drawings is like, sorry, I don't say dividend. Dividends are income that are due to them based on their investment in a company. So we say, oh, they cannot just withdraw from the company's account anyhow, but they are due to receive dividend because of their stake, their investment in the business. Dividend is a separate treatment from what? From drawings. Why drawings are expenses? Dividends are treated in 2 ways. If it's sorry for people that do not understand this dividends of it, he has asked an advanced question and I need to explain it. Dividend can be a proposed dividend. Dividends are paid out of profit, meaning that a company made a profit of social amount, they are planning to pay dividend to their shareholders. That is recognized. How do we now pay dividend? One thing is that dividend must be paid out of profit. You cannot make a loss and pay dividend because it is the money, the profit that you make that you are paying dividend for. So dividend can be a proposed dividend. That is, we're planning to pay dividend next year, dividend of 52 million next year. When you propose dividend, that proposed dividend will be treated as a credit entry against next year. Are we together? So dividend that you pay also will be deducted. That is, you credit it to your retained earning to reduce your retained earning. I believe that that explains the difference between dividend and drawings. Drawings are normal expenses of a business owner that you will do from the business. When you withdraw it, it will be treated as a drawing for personal use. While dividends are legal, acceptable payment to the shareholders of the company. Eniola Ajayi. Eniola Ajayi, is it that you have a question or you're just raising hand? Abi, they greet me. In the absence of no question.
I have a question. So I have a question.
Ask your question, ma.
Can you hear me?
We can all hear you. We can hear you.
Okay, so I want to ask that, can we categorize dividends as profit sharing that they do in this banking system or performance bonus that they do in a day company? Thank you.
Sorry, before you go, don't let me get you on. Performance sharing that they do in bank, can we categorize it as what?
I said profit sharing that they do in this day banking system. Can we categorize it as dividend or performance bonus?
Thank you. So this question is another aspect. I'm not going to say it's an advanced one. You might see it. Profit sharing, profit sharing, dividend payment, and what's the other one? You said something now. Performance bonus. Yes. You see, performance bonus, all these are staff welfare. It's the same treatment. Performance bonus, profit sharing, and everything. They will be treated the same way you treat your salaries and wages. That is, you expense them. That is different. They are employees' benefits. Employees' benefits, there's a standard for employees' benefits separately. It is called IS 19. Employees' benefits. That one talks about all the benefits that relates to employee. But performance bonus, they measure your KPI, they give you bonus, all those things are expense. They are expenses. The same way you treat your salaries and the same way you treat your performance bonus or whatever they give you. Christmas bonus, performance bonus, layer bonus, it's 2 hour bonus. They'll be treated as such. Except a situation, these ones are just normal treatment in accounting. So all these questions you are asking, people are asking, they are based on real life accounting treatment. So I'm going to explain as such. You might not even see all these things in your whatever competition you're doing for FA, but for your learning sake. So another thing I'm going to say is that, you see, performance bonus, yes, all these bonuses, commission on sales, you brought a new customer, a new client, all these ones that were saying, okay, you want me to show the trial balance you just did. Okay, sorry for that. So all these commission are treated as a cost. They are expensive. They are treated as an expense. I'm just saying a real treatment in accounting. They will be treated as a direct cost relating to what? Relating to the revenue generated. But they are still expenses. Expenses are into two forms. We have direct expenses and indirect expenses. But I don't want to disturb us with that one now. So the direct one, commission can be added to the direct one because they are commission paid to staff for bringing new customers. They are commission paid to outsiders for bringing new customers. So that is that about that. I hope that answers your question. If you see star bonus, treat it as the way you're going to treat your tribal and your salaries and wages. Thank you. I'm going to pack my bag now. Any other question? Any other question or questions? If you have any other question, please, I would advise you type it into. You can put it in on the platform, and from there I'll attend to it on my way. Thank you for your time. Thank you for your audience. Have a wonderful night.
Thank you, sir. God bless you,
Good
sir.
night.
Thank you, sir. Bye. God bless you.
You're welcome.
Thank you,
So
sir.
on
God bless
Thursday,
you, sir.
on Thursday we'll meet. Thank you, and you too, man. On Thursday we'll be meeting your new tutor. So good night. Thank you, everyone. Bye.